Hello and a very warm welcome to Policy Watch, our weekly show that keeps you abreast of all the major macroeconomic developments of the week. This week we have identified three stories, and these are: the first, the stock market gyrations; the second is on the Reserve Bank of India's recent paper on wholly owned subsidiaries of foreign banks; and last but not the least, we have the recommendation of the Telecom Commission on spectrum auctioning. And to discuss these topics with us, we have Jagannathan Tunuguntla. Welcome to the show, Jagannathan. Muhurat trading on 3rd November saw the Sensex close at a record high. Despite that, there is a prevailing sense of unease rather than euphoria, which explains the subsequent fall. The stock markets have fallen quite dramatically in the day since. Are the latest peak and the preceding rally really different from the previous peak and rally seen in 2008? The 2008 record came after a 5-year climb of the Sensex from a low of 3,000 in March 2003. The current peak comes after a much quicker rise from a level of around 15,500 at the end of 2011. More importantly, the 2000 peak came against a backdrop of a more robust economy. The 2013 peak comes against a backdrop of an economy that is struggling to grow at even 5%. So what explains the stock market behavior? Irrational exuberance, liquidity, herd mentality? We'll ask Jagannathan, but let's first hear this bureau report.
A Diwali splurge for the stock markets.
4, 3, 2, 1. Congratulations.
The Sensex hitting an all-time high note in the special 90-minute Muhurat session. The CNX Nifty hit a lifetime closing high of 6,317, up by 0.16%. The BSE Mid-Cap Index rose 1.5% to close at 6,242, while the BSE Small Cap Index was up by 1.37% at 6,020. The last time the Sensex crossed the 21,000 mark was in January 2008. The Muhurat session capped a spectacular turnaround since May to August, a period marked by abject gloom sparked by US Federal Reserve's taper talk. The reports made overseas investors head for the exit, crashing the rupee. The investors returned only after a series of measures by the government and the RBI, helped by the Fed's decision not to withdraw its stimulus program. The market rise was driven by foreign inflows of around $3.5 billion. PSU stocks gained 0.78%, followed by healthcare 0.77%, automobile 0.75%, and fast-moving consumer goods 0.61%. Except bank stocks that lost marginally on profit booking by 0.12%, all other sectoral indices ended in the positive territory. But by Tuesday, the picture changed as markets slipped to 64 points. The fall continued the next day as well. All the profit booking was said to be the reason the week ended on a note of uncertainty. Bureau Report, Rajya Sabha Television.
So Jagannathan, what sense, if at all, do you make of the Sensex? I mean, why did it shoot up like that? Why is it fallen like that? Can any investor really afford to kind of enter a market like this?
As they say, capital markets are like a cricket pitch. Who knows which way they turn? So I think capital markets are going through a liquidity wave. I think it's far away from fundamentals,
but
and the valuation technique.
Capital markets are supposed to reflect fundamentals. So when is that ultimate reflection going to come?
I think the domination of trading has become much more impactful. For example, if you closely see that trading dynamics, on a typical day, Indian capital market has about 3 lakh crores of trading volume. Out of that, 2.5 lakh crores is F&O, futures and options. Any F&O trader will tell you that they have nothing to do with fundamentals. It is hardcore trading and then topped with leverage. F&O has natural leverage involved.
Yes.
So leverage and trading, and I think anything is possible. That means the cash market volumes, that means the real buying the absolute transactions is only 10,000 crores. Meaning thereby the 90% show is with F&O and barely 10% show is with capital markets.
No, but is that a new situation that has arisen?
For example, if you see when the F&O started in 1994, the cash market used to be 90% and the F&O used to be 10%. That equation slowly changed. Even when we had a bull market from 2004 to 2008, a lot of cash market activity used to happen because lots of money used to be there.
No, why has that come down now? Is it because the retail investor is not interested?
No, when the market started correcting in after 2008, Lehman Brothers and all that,
Absolutely.
buy side activities completely disappears.
Yes.
The downside only F&O players can take advantage. Why? Because if you are a cash market player, how will you take advantage of a falling market? If you are F&O player, you can go on either side.
So are you saying the market is only full of froth and there is no genuine transaction
full of trading activity? I mean, froth, I'm not sure. Trading, that means whenever the leverage is involved, everything gets amplified. For example, let's say if there is a normal case, if a 1% fall is justified, if you are using F&O leverage, the same thing gets translated into 5%, either on downside or on the upside. That's why you are seeing such a heavy activity. Those used to be times when Nifty, if it moves by 100 points or Sensex by 300 points, it used to be a headline item in the Economic Times and all that it's a heavy activity. Now 300 points became the daily intraday activity. Why? It's simple question of F&O domination. And then the Fed and the ECB and RBI kept on behaving like cheerleaders. Earlier, they used to be umpires in a game, but now they have become the cheerleaders in IPL. So they were kept on ensuring the liquidity wave continued. Just imagine, liquidity coming in, heavy F&O positions, inbuilt leverage, and every 1% move, justified move, getting translated into 5% impact.
No,
that's the whole.
So if that is the situation, one of the biggest problems is that retail investor is really not interested in the stock market. We are getting a situation where people want to put all their money in safe bank deposits. Nobody, no, let me just finish. And nobody wants to go into equity. So if this situation continues, how can we hope to get people to get into the equity market?
Actually, the game has become a lot more complex and big. Just spare a thought. Any retail investor will come into the market with what, say 1 lakh rupees or let's say 2 lakh rupees at best. Here is a market which is having a 3 lakh crores of trading volume every single day. That means a guy with 1 lakh, 2 lakh rupees, can he even imagine the where is he standing? I mean, so that's why the stocks like S Bank and that means even solid banks are moving up 10-20% intraday, which retail investor has the guts to even to stay invested in the market.
That means it's out for the retail investor is what you're saying.
So the game has become 2020, not a test match. And
no, so essentially what you're saying is that as a result of whatever the reasons, today the retail investor cannot hope to enter a market like this.
It makes more sense for him to come through institutional investor. That
but
is
even
like
mutual funds have done very badly.
Very
so
badly
the experience of mutual funds has been very bad.
By definition, mutual funds are long only. That means they can make money only when the markets go up, because they are not by definition allowed to short, in the sense they are not allowed to take the advantage at the downside. Last 5 years is a bear market, so they never made money.
No, you say it's a bear market, but you've seen the stock market go to a record high. So there's a contradiction in what you're saying.
What I'm trying to say is that it's a general bear market and dominated by only select few stocks. If you and one more interesting dynamic in the whole thing is that the 4 stocks, Reliance, L&T and Infosys and ICICI, these 4 stocks put together are having about 40% weight in the entire Sensex, meaning thereby all other 26 stocks one side and these 4 stocks, if they reach the all-time high, the Sensex is bound to reach all-time high.
Not to mention the other, a whole lot of mid-caps who are not there in the Sensex at all.
Absolutely, they are not at all. So, gone were the days where the Sensex or Nifty is a clear reflection of the market mood. By no means. I think it is being dominated by the 4-5 stocks, which are the heavyweights. They are pulling the entire load and making it a misguided enthusiasm on the market that they are doing well. So, stock like ITC, all-time high, HUL, all-time high, Infosys, all-time high.
So, basically the key takeaway that I get from your conversation is that it's not a market for retail investors. Please stay away. So on that note, we'll just slip into a short break, but please stay with us. We'll be back very soon. Welcome back. Well, we have a large number of foreign banks of all shapes and sizes functioning in India. What is common to all of them, however, is that they are present in India as branches, not as wholly owned subsidiaries. The RBI now wants to nudge these banks into changing the structure of their Indian operations from the existing branch form to the wholly owned subsidiary form. A rose by any name should smell as sweet. So why is the RBI so keen on the wholly owned subsidiary structure? What is the carrot that it is dangling before these banks to make them bite? We asked Jagannathan for his take, but first our bureau report.
The Reserve Bank released its guidelines for setting up wholly owned subsidiaries of foreign banks on November 6th. The policy is driven by 2 basic principles outlined by new Governor Raghuram Rajan some time back. These are reciprocal treatment and only one form of presence, either as a branch or as a wholly owned Indian subsidiary. Rajan had already indicated that the banking regulator would prefer wholly owned subsidiary model for foreign banks, offering them almost equal treatment as given to Indian players. These subsidiaries will only be required to obtain Reserve Bank's approval to operate in some sensitive areas. New policy framework is in line with India's commitment at World Trade Organization. The new policy also provides safeguards against domination of domestic banking industry by foreign players. The Reserve Bank has mandated that those foreign banks with complex or restricted ownership structure and also those with inadequate disclosure norms in their home jurisdiction, or those banks which are legally bound to give preferential treatment to depositors of the home country in case they wind up, can only enter India as a wholly owned subsidiary and not as a branch. Other players can go for either the subsidiary or the branch route. A foreign bank operating through branch mode will have to convert into a fully owned subsidiary if its business in India exceeds a certain size. These banks will have to follow strict corporate governance norms. The RBI has also allowed foreign banks to dilute their stake, but in order to do that, they will be required to list in the exchanges. Bureau Report, Rajya Sabha Television.
Jagannathan, why is the RBI so keen that foreign banks should function as subsidiaries, not as branches?
I think it gives the entirety, because if you are a branch, by definition you are not a owner in the sense that the branch is functioning as just an extended arm of the foreign player. In wholly owned subsidiary, of course, it's the same applies, but because you have the corporate structure, that gives a lot more regulatory authority and power to the RBI, and moreover they can able to easily control the activities, because as of now in an Indian banks, RBI has the full authority and control in that sense. But when you are a branch of a foreign player, definition your authority reduces, because they always can claim that they are regulated by the foreign entity, foreign regulators, and RBI will be maybe a second regulator to but once it's a wholly owned subsidiary, I think the RBI say
so the RBI feels it has greater control. But one of the carrots that is dangling before these banks is that they say that if you get converted into a wholly owned subsidiary, then you have greater scope for branch expansion. But under the WTO, that is the World Trade Organization, our commitment is only to allow 12 branches per year, and it's on the basis of reciprocity. That means we allow a foreign bank to come into India if the Indian bank is allowed to go there. Now, many Indian banks don't have that facility of reciprocity. So what does it really mean? If under WTO I have a ceiling of 12, what is the great idea? Which bank will bite? Which is why perhaps hardly any bank seems to be interested. So what is your take? Do you think it will make a difference at all to banks?
True. I think everything will evolve over a period of time. I think as far as that branches is concerned, any which way, most of the foreign banks operate in the metro cities. In the sense, I mean, they are not by definition, they don't want deep penetration in that sense. They are not a rural player like SBI. So I think probably most of the they would like to have footprints in the large cities. I think that number probably will suffice, because in major business areas, and on top of that, they would like to capture most of the foreign business, in the sense that export, import, and NRA, that kind of stuff. I think to that extent that it's not the number of branches that determine the whole scheme of things, and where that foreign business will matter to India is that India wants to show that it's open in that sense for the business, as Raghuram Rajan is also trying to include Indian bonds in the global indices. Yes. What it is trying to do is that integrate the Indian system more into the foreign system. Of course, with a caveat that he keeps saying that I'm an Indian. So in that sense, I think he's trying his level best to integrate. But I don't think this makes such a big difference in the whole scheme of things.
One more carrot that they're dangling, that the Reserve Bank is dangling, is that they're open to the foreign banks taking over private sector Indian banks. Now, do you think there would be any private sector Indian banks with it could be attractive, particularly amongst the old private sector banks? I think there might be some kind of potential banks which foreigners might want to acquire.
Many Indian banks were getting excited. For example, many banks with troubles, like say Dhanlakshmi Bank, and you can go on and on names. The Karnataka Bank, for that matter. So I'm sure they will be willful sellers, because they have started with lots of anticipation, but something or other went wrong. Maybe slowdown, maybe NPAs, whatever, you can on and on. I think I'm sure they would like to sell it up, provided they'll get decent valuations. And now, considering that RBI is more and more willing to allow the foreign banks to come in, I think at least one or two case study deals will be happening. Even foreign players would like to do a small deal, let's say $50-100 million, which will not be that much impactful for
but are the foreign banks themselves in a position? After all, they've been under suffered a lot of losses. Their financial position is not too good. They're under the regulatory glare and overseas. So they themselves are not doing too well. So would they have the money or the interest and their appetite really to take over a small Indian bank?
They are fairly large players. For example, if you say their balance sheets and their capacity is much bigger. On top of that, they can always do the share swap deal, in the sense they can always issue the foreign shares. So that means we need not put in money on the table. On top of that, the players like Karnataka Bank and Dhanlaxmi Bank at 1,000-2,000 crore market cap should not be such a big deal.
Should not be so difficult.
Yeah.
So on that note, we'll slip into another short break, but please stay with us. We'll be back very soon. Welcome back. Once upon a time, telecom was a sector that was singularly blessed. Nothing could go wrong, or so it seemed. In contrast, today it seems nothing can go right. The telecom sector has become almost synonymous with controversy. Will the latest decision by the Telecom Commission to hike the reserve price for the next round of spectrum auction, overruling some of the suggestions made by TRAI, the sectoral regulator, change that? We'll ask Jagannathan, but first our bureau report.
The apex decision-making body in the Department of Telecom has suggested up to 25% increase in spectrum prices suggested by telecom regulator TRAI. Telecom regulator had suggested a base price of rupees 1,496 crore for 1 MHz spectrum for a pan-India license in 1800 MHz band. However, the Commission has recommended a base price of rupees 1,763 crore. The Commission has also recommended a new base price of rupees 218.9 crore in Delhi, rupees 206.7 crore in Mumbai and rupees 73.13 crore in Kolkata. Similarly, for the more valuable 900 MHz spectrum, the base price per megahertz will be rupees 359.65 crore for Delhi, rupees 327.5 crore for Mumbai and rupees 125.27 crore for Kolkata. Telecom Secretary M.F. Farooqui told reporters that we have taken a decision on the pricing of 1800 and 900 MHz and also for mergers and acquisitions. The new merger and acquisition policy allows mergers that lead up to a combined market share of 50%. It would replace the current cap of 35% for the new entity. Companies will also be allowed to retain 2 blocks of 3G spectrum after the merger. The government can earn at least rupees 11,000 crore in this fiscal by auctioning radio waves for telecom usage. This will be the third round of auctions since the country's apex code had cancelled 122 licenses last year. 2 previous rounds of auctions have been subdued as very few companies participated, citing high reserve prices. Bureau Report, Rajya Sabha Television.
So Jagannathan, will we see the end of controversy now with this? Because we've seen, back and forth in telecom happening so often now.
I think it's somewhere in between. I think by not accepting fully and at the same time by keeping 15%, 25% above the suggested price, I think they have done fairly decent job for all the players, because players were relatively happy when the recommendations came in, because the prices were a lot lower.
But shouldn't the regulator have the final say? What is the idea of a regulator if the regulator says one thing and then you have a commission overruling the regulator?
I think it's most of them are recommendations. With due respect, I think commission will have the final say.
That's what it seems to be, but I'm just wondering what is the role of the regulator really?
To give the recommendation. They are not the policy making body in that sense. They are a regulatory body, at least in the telecom structure. That is how telecom industry is structured in India. One thing is that everybody knows that honeymoon period is over in Indian telecom, because the roof is hit in terms of the opportunity of growth. Because simple equation, India has 100 crore mobile connections, meaning thereby in a country of 120 crore population, already 100 crore mobile connections. So where is the next growth come?
These days people who want more than one phone, if you see
even if you factor in that, the remaining people, whoever is not subscriber to the mobile, who doesn't have the mobile today, at best he will be an incoming player. So that means he will buy the mobile just for getting the incoming calls. So he is not going to be a revenue creator for the telecom players.
As income levels rise, I think you will find revenue growth also happening. Initially, yes, a person's perhaps income level is too low.
Actually, when the competition increases, actually it works other way around. I think actually the prices, there is a risk of pricing points going down, because it has nothing to do with the earning capacity, earning power. It has become a necessity in that sense. It's a competition between the players will determine the pricing, not necessarily the paying ability of the customers in that sense. So that's why they are trying to bet upon 3G, 4G. But I feel in India all those things don't work because even 3G, 4G only corporate level organizations may take, enterprise clients will take, not the general customers. Because you see, India is a simple place where people would like to talk because people love talking. That's why telecom industry has become so big. But beyond a point, a person in Coimbatore, just a person in Andhra, so who doesn't fully understand say English, and he cannot even type a message. Meaning
No, but now you have, if you even keyboards, you have them in different languages. So
true,
likewise,
but their penetration is quite limited in that sense, because when was the last time you have seen, because it's still I think English contributes to 98% of the Indian messages. So while many attempts are being made to get the additional revenue through other languages, linguistics, etc. But make no mistake, I think it's just the talking that gets the
So you're not very hopeful about data being a big revenue source?
No, I don't think so, because except the youngsters in metro cities, that is the only growth opportunity. Barring that, if you see, that's why if you see any ads by the any telecom player, they are showing the youngsters, that typical hip hop youngsters, and that's the only market they know that they can able to cater. They are not showing the rural place in that sense, because the talking aspect is saturated. Now it's like royalty. That much money they can keep making money, because by definition people will be keep talking. So that is a saturated market. It's a royalty growth. That's why Bharti went to Africa, but that integration took too long.
So is this the last opportunity for the government to get money from spectrum auction?
Probably. I think even here, I don't think they will be that aggressive bids. I think at best probably they'll get the whatever the base prices that were set, because everybody realized that last times when they paid, it hurt their balance sheets.
So they've learned a tough lesson, I think. So 11,000 crores is perhaps the best they can hope for. With that, we come to the end of this program, Jagannathan. Thank you so much. It's been great having you. But before we close, a quick look at the key takeaways. As far as what's happening to the stock market and helping us to try to make sense of the Sensex, if at all, Jagannathan says the game has changed completely, which is why retail investors is just not the market for them anymore. As far as the RBI's position on the wholly owned subsidiaries of foreign banks is concerned, it's a little early to say, he feels, but by and large there should be some foreign banks who are interested in some small players, because for them it's just chicken feed. And as far as telecom auctions are concerned, he thinks this is the last opportunity for the government to get money from spectrum auction, because in India the market really is about talking, and as far as that is concerned, the market is really saturated. And with that, we come to the end of the show. Thank you so much for being with us. It's goodbye from all of us at Rajat CV, but we'll be back next week, same time. So please stay on.